New measures are being proposed to better prepare electricity retailers for price volatility and protect consumers if they go bust. Now, these companies may be required to have a paid-up capital or tangible net worth of at least $1 million and compensate consumers if they exit the market or end contracts early. The Energy Market Authority wants the capital requirement to ensure sellers have sufficient financial standing. It's also proposing that all retailers hedge at least 80% of their retail contracts on a rolling 24-month forward basis. That's to better guard against market volatility. Plus, new rules to prevent retailers from unilaterally ending contracts when there's no defaults, and for retailers to compensate consumers for early termination. At least one retailer, backed by a power generation plant, is backing the move. Sunoco Energy is expecting higher barriers to entry for new entrants, but it sees this as a small price to pay for stability, certainty, as well as energy security.
Now let's take a closer look at why these measures are now deemed necessary. Let's start in 2017. That's when Singapore's government announced the Open Electricity Market, or OEM initiative. Its aim to promote competition in the industry, but more significantly, to give customers more options at lower prices. Now, the OEM initiative rolled out nationwide in 2018. Retailers selling to consumers in the open market are either retailers that generate and sell their own electricity, or independent retailers who buy electricity from the wholesale market, where prices fluctuate depending on demand and supply. Now, trouble came in late 2021 with the onset of the global energy crunch. Weather events, energy market turmoil, and surging global demand all contributing to electricity's high price volatility. Of 15 independent retailers at the time, 6 exited the business and 2 prematurely terminated their contracts with consumers, roiling the local energy market. The Trade and Industry Ministry announced last October that the Energy Market Authority would introduce more protections this year, and they're aimed at strengthening the existing market structure for retailers and consumers. Now, for more on how this will impact business and consumers, we're joined by Dr. David Broadstock. He's Division Head of Energy Economics at the NUS Energy Studies Institute.
Welcome, Dr. Broadstock, and thank you for joining us. First off, how effective are these new measures going to be?
Well, thank you for having me. The new measures will go a long way in helping protect consumers. This has been one big concern since the exit of iSwitch and the market events. There are 2 complementary parts to the measures. There's actually making sure that the caliber of the market participants remains high and possibly higher than they had been in at least the past 18 months or so. And then at the same time, making sure that those consumers which are forced into needing to find a new supplier for their electricity may be compensated for any losses they may be unfairly facing.
Now, when you look at all these measures in totality, does it strike you as being particularly onerous? Like, which of these measures would be difficult to implement, you think?
Well, the joint collection of measures which are being proposed will be certainly raising the hurdle to enter into the market as a retailer. To the extent that we may think of them as being onerous, well, the paid-up capital or tangible net worth requirements shouldn't, I think, be terribly onerous, but the move to an 80% hedge requirement is going to change market operating conditions potentially quite far from where they are today. So this may take retailers some time to adapt to. Yes. Yeah.
How would those operating conditions change for retailers? Does it mean, not being able to offer as competitive a price as before, perhaps?
Well, I think it will promote fair pricing with long-term stability. And, the extent to which we may see lower prices, I think that's not necessarily the only thing we need to keep in view. It's fair pricing. The prices must be right, but not something that becomes an unpainful situation for those consumers of electricity. So the 80% hedge requirement will actually create a longer-term planning process, as in companies will need to be thinking out and actually making sure there's provisions for their contracted electricity over 2 years. And then only 20%, whereas previously it was up to 50%, of the electricity would be purchased off the spot market. So hopefully that will create long-term stability. It actually should, I think, have the effect of reducing the overall volatilities that we see in the market by itself.
So you spoke earlier about the fact that these measures may well improve the caliber or quality of entrance into this market. But is it going to dissuade companies from coming in? I mean, are the barriers going to be simply too high, too arduous?
I don't think they'll be too high. The barriers certainly create a new requirement for participating in the market, and this will be something that people will question: is this right, and does it potentially negate the need for an open electricity market in the structure which it is in today? I don't think that will necessarily be the challenge here. What we want to be able to do is to continue to open the door to competition, and so the proposed enhancements do not close that door, they keep that door open. The market conditions are very complicated at the moment. They have been for some time, and they are likely to be globally for at least another 12 months. And so what we have is a suite of measures that should increase robustness within the market. By improving the caliber, there's much less risk to everybody involved. Does it mean that we may not see so many discount off arrangements? This might be a question which some ask. At present, we don't have many discount off opportunities being offered by the open market. And this has really been the case very much since iSwitch left the market and around about that time. So those conditions won't change as a result of these enhancements.
You mentioned earlier that some questions were raised or are being raised of the open electricity market. What's your view? Where do you see the future of the open electricity market?
There are many benefits to permitting competition. Competition is, it's a way for retailers and other market participants that can potentially do better than the government-related, the regulated supply arrangements, to demonstrate that and to test that, and hopefully to encourage new technologies being deployed on that side, alternative pricing mechanisms. And I think permitting competition is a good thing. It really only opens up more opportunities for consumers. So I think it still remains a good thing to keep the market structure. But whether it remains entirely fit for purpose, that's what's been tested. And I think similar to other regions and economies, Europe, for example, there's a need to continually review, refine, and enhance those mechanisms.
Right. Dr. Broadstock, thank you very much for coming into the studios to shed some light on these new measures. Dr. David Broadstock, the Division Head of Energy Economics at the NUS Energy Studies Institute. Thank you.